right. Well, we'll go ahead and get started here. Welcome everybody to the property sale process webinar. A quick disclosure, this is not a research report or investment advice. All opinions expressed in this webinar are those of our presenters, and past performance is not indicative of future results. Welcome to the Arrive Property Sale Process webinar. We'll walk through who our speakers are today. Cameron Wu, our VP of Investments, Jeff Talbert, Director of Investment Valuation, and I'm Korin Hedlund, and I lead our investor relations team here at Arrived. A brief agenda today. Cameron will walk through the intro to property sales, philosophy and considerations for our single-family residential properties, and then Jeff will walk through the selling process, and Cameron will close us out with the investor perspective and what folks can expect if one of their properties is listed for sale. And then we will jump into Q&A. You'll see we have quite a few folks in the chat from Arrived. Jake in particular and Brett as well will be answering those questions in chat, and then we'll also tee them up to answer live after prepared remarks. And I'm going to go ahead and welcome Cameron up to the stage, and I'll catch you all at the end.
All right. Thanks, Korin, and thank you for joining everybody. So excited to do this webinar today. We're talking about a topic that's been addressed in various webinars, kind of in passing or some through Q&A, but excited to talk about property sales at Arrive. So want to first talk some philosophy and what guides our decision-making. How do we view when to sell? So the philosophy is that if we can continue to hold the investment and your gains will increase from an annualized perspective, then we're going to hold on to the investment. If we think that we're kind of at the apex of where we would be able to get the highest returns, is it a good time to sell? Or if we held it longer, would that average return go down? Then we start evaluating for a sale. Now, this is a fairly simple North Star that we have, and it's a bright one. There's a lot of complexities involved in investments as far as what influences the price, when is the right time, but we try to reduce it down to that fairly simple consideration just to make sure that we have kind of a compass to go by, because it can get complicated and a lot of it is situational. But very simply, if you hold it for longer and your returns are better, we're going to hold it. Okay, so let's also talk then holding times and liquidity. And to level set, what is liquidity? It refers to the idea that you've got an asset, you want to turn it into cash that can be deposited into a bank account. How quickly, easily can you do that? The more liquid it is, then the more easily that you would and quickly that you would be able to turn that asset into cash. And traditionally, real estate is considered pretty illiquid. Now, residential real estate, and especially single-family residential, it is the most liquid of the real estate class, because everything else would be multifamily, office space, commercial properties, industrial. There's only a limited set of buyers for those types of properties. But with the single-family residential home, it's the American dream, right? It's that proverbial own a home. So there's a lot of buyers and sellers, and that creates a more liquid market. But at the same time, it's a six-figure asset. It costs hundreds of thousands of dollars. It's probably the biggest investment that most people make in their lifetime. So there can be barriers and there can be a long lead time to making that leap to purchase real estate. So typically there's two ways to get liquidity out of real estate. You sell it. There's another buyer that comes in and pays you the price, and then you get your money. Or you can do some sort of financing, taking out debt. And it comes in a couple different forms. So you could have a mortgage on your property, and as property values go up, you could refinance the mortgage, which means get new loan terms and then get a new loan amount. And sometimes that means getting equity out of your home because the price has gone up on the property. So that's one way to get it. Another way is a home equity line of credit, a HELOC loan. So even though equity is in the word, it is a form of debt, right? You're tapping into the equity kind of on a revolving credit line. So those are the traditional ways to get it. And, it's needs improving. So, we have a lot of investors in each of our properties. On average, it's somewhere between 500, for kind of an average property, all the way up to 2,000 for some of the larger properties. So we wanted to improve the idea of liquidity on Arrived, and have the flexibility to, sell your investments on your own timeline without being reliant upon a full exit of the property. So, really emphasizing that liquidity is one of our top goals as a company. And I think it's one of the most important features of investing is, okay, you may have conviction to get in, but how do you exit, right? And that can be further into the future. And especially with real estate, it can have that long tail of holding it. But we wanted to really improve upon the experience, and we think we're able to do it with the Arrive business plan. So happy to take more questions about liquidity and the various programs that are in development and that we already have. But the majority of this webinar is going to focus on the actual traditional property sale process. As we mature as a company, we're getting close to the timelines where we're selling properties. So we thought it'd be a good time to bring it front and center. So next on selling considerations. Okay. Sorry. So the big question is, when do you go from renting mode to selling mode, right? We purchase the properties, we stabilize them, we get long-term tenants in, and we kind of keep collecting that rental income until the market is telling us, hey, now would be a good opportunity to sell. And it's not always the market that tells us that in terms of property price appreciation. There could be individual income performance that dictates that. You could have two properties in the same market and we can make one purchase at the same time. And there's one conscientious effort to sell that one property and hold another. Maybe the income potential for the property that we want to sell has not been as strong as the other one. It could, the house could have issues. So, those are the types of reasons why you may also sell a home independent of kind of market appreciation. One of the biggest factors that we look at is the property vacancy cycle. So our average lease is 18 to 24 months. So we have to make decisions with a long lead time. And just as a refresher of why do we structure our leases that way, we prefer biasing towards tenants that have a long-term vested interest in staying in the property. One of your most costly components of running a rental operation is what's called a turn. So it's when the prior tenant moves out, home goes vacant, you repair it, and then the new tenant comes in. But there's risks associated with that. A vacant property is much more liable to have damage, or if there is damage in it, and without constant eyes on the property, that damage can escalate. So we have to be very cognizant of living in the future, because if we do decide to lease out a property, we're basically committing to another year and a half to two before we could sell the property again. So there is that consideration. And when we're thinking about sales, we're often looking at the subset of properties that have recently become vacant as potential sale candidates. The second, refer to the market. Are there good gains to be had? We run rental income properties. So one of the nice benefits of that is if there hasn't been appreciation in the market, then we continue to hold for income, right? And that's really one of the great optionality components of investing in rental real estate, is that it is a fundamental need. So over time, it does tend to appreciate. There ain't making any more of the land, right? So it is an asset that is historically appreciated, but like any asset, it has cycles of up, down, being stagnant on price. So we may not experience the appreciation in the short term, but that's okay, because when we underwrite our properties, we underwrite them for the long term to be cash flowing, even if it has a mortgage for the long term. So the name of the game is really being able to have staying power, right? Because you want to be able to time your divestment of that home to align with market appreciation. So generating that income in the meantime is the best way to do that. Is the property likely to have future expenses given its age? So, the physical world is real. Entropy does its thing. Homes break down. Mother Nature has a say in that. So the older that properties get, and the longer that we hold on to them, we have to anticipate that we could have had a good run where there's no expenses, but eventually, the tax collector comes knocking, and you got to pay the bill, both on literally taxes, but also kind of that wear and tear that eventually needs to be repaired. So, the longer that we have a good run, the higher likelihood that you will incur some more major future expenses. So if we can kind of circumvent that and exit the property before those start hitting, then we think we're doing right by investors of optimizing kind of that window of when we have to sell. Another consideration is, there something about the market that'll make it more difficult to operate going forward? So property tax comes to mind as that scheme can change on a year-by-year basis, as well as insurance. Insurance is a very dynamic market. You're only locked into your premiums a year at a time for most insurance policies. So to the extent that, again, Mother Nature, who has a very strong opinion on on what we do, the insurance rates can rise quickly, and we've seen that in Florida. I think it's a great market. We want to be buying more in that market, but it's just been tough because the insurance costs have effectively gone from roughly sub 1% to over 2.5% in a matter of about 4 years. So that becomes a real material impairment on being able to operate in that market, and it can accelerate your decision to sell in a market before the market says, hey, this may be the apex of appreciation, but insurance costs may force your hand on the cash flow part. And then finally, is there a mortgage on the property to lever the returns? So the nice thing, we're big advocates of having mortgages on properties when the interest rate is reasonable. Lately, over the last 2 years, it hasn't been reasonable. We don't think it's been a good economic investment to lever homes. So we haven't over the last 2 years. But to the extent that there is leverage on a property, then there's also the chances that it magnifies the returns. So the threshold of market appreciation could be lower, and that leverage effect still impacts it where you get a higher return. So we really like that leverage because combined with having the flexibility to have good rental coverage ratios and stay in the game, then we can have more flexibility with when we sell to still get a fairly good return. So those are some of the selling considerations that we think about as we try to anticipate, the decision today with considering 2 years, far out into the future. And that's generally the residential real estate investing game, is that you're always having to place your mind and your considerations 2 years out, 5 years out, 10 years out, because where you buy today, you eventually got to sell it for liquidity. So, we often live in the future in our mind. And I guess the final point that I'll go over in selling considerations is that we want to be able to sell to owner occupied, or at least have that option. And that's why we emphasize the property vacancy cycle, that when it does come vacant, we want the option to be able to sell it and list it on the MLS and have an owner occupant come in and buy it. Especially as interest rates coming down, more buyers are able to purchase a home as their purchasing power increases. And generally, an owner occupant is going to pay a more favorable rate because they're not really looking at it in the same kind of cutthroat investment way that investors would. So listing on the MLS gives you both the option of having the investor crowd look at it. We source from the MLS as well. All the kind of real estate platforms, Zillows, the Redfins, they're all aggregating from the MLS. So it really provides the most visibility. So, whether an investor purchases the property or an owner occupant, we want the optionality of both. But to be able to sell to an owner occupant, you generally have to have the property vacant and not subject to a lease. Because if there's 9 months left on a lease, and then you may be able to negotiate it and kind of break it with the tenant if they're willing to. But otherwise, they're entitled to stay in the home subject to the lease. So you have to sell the property subject to the lease with the tenant in there. So it kind of eliminates a lot of possibilities in terms of being able to sell to an owner occupant. So that's why we would look to that population of vacant homes as kind of a starting point of making sure that we get the optimal price for investors to be fully marketable to both owner occupants and investors. So with that, we went over the philosophy, we went over selling considerations. How do we go from rental mode to selling mode? And also one last note on selling is that we don't necessarily have to sell and commit to sell once we list a property. We could test the waters, see how the market's responding. And if we don't like what we're seeing out there in terms of the ability to sell it, we can always release the property. It's been turned, renovated, good condition. It's just a matter of kind of changing out the yard sign from for sale to for rent, and we can continue to hold for cash flow. So yeah, with that, I'm going to want to welcome Jeff on the stage, and he is going to go more into the tactics and process of selling a home.
All right. Thanks, Cam. So yeah, this slide is a lot, and I know Cam went over a lot of information about kind of how we think about which homes we select and kind of the timing. I'm going to try to go into more of the execution piece and the actual specifics. There's really a ton of information here, Brett linked something in the chat that's also really good, a good resource for that. So I'm going to try to hit some of the highlights. So once we've decided to sell a home, I think go-to-market strategy is kind of an important thing that we do. So we really have to think about tons of things. You know, who we're going to use to sell the property. Do they have local market knowledge? You know, from things kind of as simple and expected as pricing to things about, you know, we have to look at the neighborhood and see if there's anyone else on the market in the same neighborhood for differing prices. So there's a lot of timing components, seasonality that really affect how we're going to go to market and how we're really going to try and achieve the best price for investors. Once we kind of get there, market preparation, I think one of the biggest things to highlight is going to be twofold, and both are kind of on the appearance of the home. So one is going to be the rehab. So rehab for sale is going to be different than potentially rehab for future tenants by a little bit. We're going to look at putting money into things that we think are going to maximize resale value, not necessarily things that renters are going to be looking for. So there's just some different dynamics there in terms of the market prep that come into play. Once it's live on market, so once the home has actually hit the market, and this is really where I'm involved in the company already in pricing the home. So price monitoring for us on a for sale home is going to be really important. You really, in 2024, there's still there's reasonably low inventory levels still. So the market is still reasonably favorable to sellers. But we've seen a little bit of change towards buyers recently. And in that environment, as of right now, especially, we really have to be careful not to overprice our homes. If you put something out that's overpriced, even though there's not a lot of inventory, the home will sit for quite a while. So we really have to watch our price. We really have to use our partners as a resource to advise us on how things are going. We have very, very frequent meetings with our broker partner to look at the feedback from the showings, figure out how many people are inquiring, things like that, to see if our price is really matching the market. And again, just really helping us, you know, find the right spot to get a good price, to actually sell the home, right? Because if you go out too high, you're probably going to wind up sitting, and then you're probably going to wind up getting offers that are not what you want. And finally, on this slide, I'll cover a little bit of under contract. This is actually kind of interesting. So, you know, once you actually get the ink on the paper and you get someone under contract, there's still some stuff to go, right? As part of our acquisitions process, when we buy, we always try to go in and ask for repairs, do a ton of due diligence, make sure we're looking at all of the big systems of the house, things like that. And we should expect, hopefully not quite as much, but we should expect similar things from buyers. So, you know, we need to make sure that we are addressing kind of big issues before selling, and we're aware of how to go back and forth on negotiating these things once it's under contract. That really help get you the best result even after you've kind of inked the deal on the headline price. And now I'll kind of briefly go through a few slides. Again, there's tons of information here, and I'm going to try to highlight, you know, kind of the big things. So Cameron mostly went over how to decide when to sell. He briefly touched on market and kind of tax rates and things like that. I think from a high level view, since I'm, again, heavily involved in the acquisitions, we're always kind of thinking about where do we want to be buying and where do we want to be thinking about selling, or potentially even there could be some that don't work in a market that we still want to be buying in. But we're really trying to, you know, figure out on a macro level what parts of the United States we want to be invested in, what segments of the market we want to be invested in, things like that. So all of that's going to factor pretty heavily into deciding what, you know, when we want to sell, and maybe we think investors could have an opportunity to do better in another type of asset. Preparing a property for sale. We talked some about this. I think a couple things maybe we didn't touch on. Virtual staging is something we do, and virtual staging is something we actually do for our rental listings as well, right? Virtual staging, when I was in real estate, 7-8 years ago, virtual staging was it wasn't very good yet. And it's gotten substantially better. And it is extremely more cost effective than physical staging. So virtual staging is a very high ROI item to me that makes a home look tremendously better for a very low cost. And that's one thing that we make sure that we do before we sell. And again, market-driven pricing. I touched on that a little bit, but we're going to do a ton of research, comps, ton of research in terms of using our broker partners to advise us on the price and things like that to really understand what we can achieve and what we think will drive a successful sale quickly. On selling a property offering, I think the thing I'm going to highlight here is the ongoing maintenance. So, we did talk about doing a turn and addressing items that might help drive a higher sales price. But ongoing maintenance is really huge. Things like, making sure that the house is clean while it's on the market, making sure that the lawn is mowed. There are so many things that are a little bit more at risk with a home that is vacant, much less a home that's vacant and has people going through it. Ongoing maintenance is actually something that's really important. And then list price, again, I went over this already, but we need to iterate quickly on the list price and make sure that we are staying competitive, make sure the property still looks attractive to buyers. And then finally, here I want to talk about kind of underwriting a buyer a little bit as they come in. So obviously not all buyers are equal. As Cam said, we're probably going to mostly be targeting owner occupants. And when someone submits an offer, we're going to look at it very closely. How much earnest money are they putting down? When do they want to close? Is it contingent on a sale that they already have? What's their financing look like? So, we really need to figure out, do we think this is someone that can perform and can close before we get under contract with them? Because if not, it could result in taking a month or two to work through and then fall out of contract, and could just, result in not a great experience for our investors. So really want to make sure that we are looking very closely at the offers to make sure that it's not just a great price and provide great returns for our investors, but we get kind of assurances or high expectation of closing. And with that, I will bring Cameron back on stage to go over another point before we open it up for Q&A.
Yeah. All right. So real quick, how our proceeds are distributed to investors. And we get this question a lot on what happens at the end of investment. How do I get paid back? And it's fairly simple. So let's say that the property sale happens, it goes through, money is deposited into the LLC's bank account. And then from that represents kind of the sum. Well, I should say that there is an accounting treatment where, you have cash in the bank account. If there's any other current assets or current obligations, those are all netted out such that we get a true cash number. And then from that point, we will send that on a pro rata basis to your arrived wallet. And then from there, you can choose to, withdraw it to your bank account or reinvest in other investments. And then at the end of the year, you'll receive, well, I should say in January, you'll receive a 1099 tax form, much like you receive for all of your arrived investments that indicate, your dividend amount, your distribution amount, and the amount of repayment of principal. You'll just see a larger amount in that repayment of the principal and the gain, and then that will translate into the capital gain that you would also, much like when you sell shares of a company, a public stock, it would be treated in that same way because these are also shares that you own. We can review some of the information in Q&A about how's the investment structured, because sometimes it's not clear to people that they are owners of shares in a company that holds real estate as opposed to being a co-owner on the deed itself. So, I analogize it to a brokerage account where you're, taking a gain on shares because you are invested in shares on the Arrive platform. So with that, we will invite Korin back on stage, take some questions, and hopefully clarify any points that we can for you.
Wonderful. Jeff and Cameron, thanks so much for prepared remarks. We have quite a few questions coming through the queue. As a reminder, keep those questions coming as they relate to the property sale process. You'll either hear from myself or Jake in the chat as well. All right, moving back over to the queue here. The first one we have is, will investors be able to weigh in on when and what properties to sell? Cameron, I'll kick this one to you.
Yeah, great question. So the quick answer is that Arrived has full discretion to make the decisions on all aspects of management of the property, as well as when to sell, and kind of the context as to why. So as I'd mentioned in prepared remarks, we have 500 to 2,000 investors in every single individual investment. We've kind of toyed around with the idea of voting mechanisms or which parts, is there a veto power? So I think that those ideas are still in process, trying to find the right blend of kind of representation from the investor, but also kind of decisiveness and utilizing Arrive's kind of market knowledge and expertise to encourage a sale. But from a management structure point of view, we do retain that full discretion too. With that said, I want to fast forward to the medium term future when we have the secondary market as a liquidity program available to investors. Currently, we have a redemption program that is available for the fund products. So the SFR fund and the private credit fund, there is a way for you to turn your shares into cash value, get that liquidity, but it currently doesn't exist for the individual offerings. It's probably the number one priority project that we're working on right now, is to open up that liquidity option for individual offerings. This will look more like a secondary market program, which I think more people are familiar with than, say, a redemption program. A secondary market program allows buyers and sellers to directly exchange shares in the investments, and that's how you get your liquidity. So if you think about Robinhood or E-Trade, those are brokerages that allow you to buy and sell on secondary markets, New York Stock Exchange, NASDAQ, et cetera. Those are all secondary markets for which securities are exchanged. We would have something similar, although, wouldn't exactly be that, but in essence, it's buyers and sellers coming together to set the prices with each other. So that will allow you to exit on your own timeline. It'll also give us more flexibility on how long we hold it, because if every individual investor is able to exit on their own timeline, they could ride it out to the very sweet end, or they could get their cash on their own kind of schedule with liquidity programs. So I think it's important to both recognize the management structure as it exists today and kind of the necessity of Arrived having that full discretion given how many shareholders there are with each investment, but also allowing for an option for you to have your own individual liquidity option that is independent of when Arrived decides to sell the property.
Absolutely. Very well said, Cameron. Definitely appreciate the feedback. As a note, we do have 2 properties out of 400 plus that are currently up for sale now. So it's very, very timely. All right. Moving back over to the queue. Cameron, a little bit of a different direction. And Jeff, if you have any color here too, how does the distribution for single family residential fund when we sell a property? What does that look like?
Yep. So within the fund, that is just to illustrate the difference between the fund and the individual offerings. In individual offerings, you have one LLC that holds one property. It's a one-to-one relationship. In the fund, you have one LLC, the SFR Genesis Fund LLC, as its official name, and multiple properties underneath. Currently, there's about 40. So when you sell a property within the SFR fund, you basically, exchange out an asset for more cash in the fund. And there's some options there. You could make a distribution to the shareholders, or you could take those proceeds and reinvest it into another home. So if we've done a good job of selecting properties out of appreciation and we sell that there's additional cash, you do have options. You could distribute all of it. You could reinvest all of it. You could do some portion of both, or you're substituting into maybe an equivalent house and there's a little bit extra and you can make an extra juicy dividend for that month's payouts. So there's also I'll add one other juicy nugget in there, is that within a fund structure, it's much easier to do a 1031 exchange. So 1031 exchange is a tax advantage transaction within real estate called a like-kind exchange. So if you sell a property, an investment property for a gain, you can buy a like-kind asset, so another investment property, and then defer the tax that gain created and roll it in to the new property. Within individual offerings, it's very complicated to do that because there's only one property. So if you exchange it out, all shareholders, have to agree that this next property is what they want, and you have to maintain the LLC structure, and like the same entity that sold has to be the same entity that purchases. So there's much more difficult constraints involved with that because you have 2,000 different people who have 2,000 different opinions, and not everyone may want to have the new property. So within the fund, it is more feasible to do that. So, it's the fund will continue to be evergreen. It'll continue to acquire property. So when we dispose it, all it does is inject cash to allow us to maneuver either with replacement properties or dividends. But I wanted to throw in the 1031 exchange there because it is a question that we get a lot from people about the tax advantage nature of that 1031 exchange. But within the fund, it is a good vessel to have that kind of activity where the fund could benefit from getting gains, getting that liquidity, but then not having to pay the taxes on those gains.
Fantastic. Awesome. Definitely a great question. All right. Moving back over here. Lots of good ones in the queue. I love the engagement today. Leslie's joining us. It's been a minute. It's great to see you, Leslie, here. Would it ever make sense to let a tenant stay in the home as opposed to giving them notice to move by a certain date, going through the rehab, et cetera, and then selling? I think this is a great question, Cameron and Jeff, because we'll oftentimes see a little bit of a delay when a property is going to be put up for sale, and there could be some months with vacancy. Cameron, I'll kick this to you, but Jeff, I know you probably have some feedback here as well.
Yeah, so when you have a tenant stay in the home, primarily you're going to be like that would be a value add to an investor, right? And it would be a value detractor from an owner occupant. So I think it also depends on the market. So it's generally true that owner occupants are willing to pay more, but it's also could be true that an investor is able to pay more, or it works out like they value it more than an owner occupant would because of the nature of the cash flows. So to the extent that you have a tenant in there with real revenue coming in and a real history of expense profiles, there may be another investor who values that tenant's in there because they may be looking for something extremely passive and turnkey. My first advice to them would be to look at Arrived for passive investments. But on the second point about, there being somebody in there, it's immediately cash flowing. So I think it could make sense in those cases where maybe we're selling a small portfolio, 3 properties, 5 properties, to another investor. If you package them up together and they're all fully occupied, I think it makes a lot of sense to sell in that group occupied as a tenant. So in that case, I could definitely see in the future we would have constant marketing efforts where investors could be buyers at any point in time. Selling to an owner occupant requires more coordination because you are forgoing the occupancy cycle of a renter coming in, because if you want an owner occupant, it really does need to be vacant when you sell the property. But with kind of ongoing operations and further development of our selling channels, we'll constantly have properties that are occupied, marketed to investors, and we could be in a perpetual 24/7 like kind of bidding process where investors are submitting bids or expressing interest on properties that we say, hey, you could sell it, or we could sell these properties. Here's the economic profile. Here's the actual tenant in place with in-place rents. What's your offer? So that could be more of a proactive way and an evergreen way of marketing properties to an investor base. But when you do it to an owner occupant base, it does have to be a little bit more intentional and calculated to make sure that the tenant's out, which is all kind of the logistics of that what you're referring to in the question.
Fantastic, Cameron. Appreciate walking through it. Jeff, do you have any color for that question that you would want to add in there?
Yeah, I mean, if this is where the question was headed, I don't think it's ever really an ideal scenario to notice a tenant that we're selling the house and you have to be out in 2 months. I mean, I'm not saying that could never happen. There could be situations that necessitate that for investors, but it's just not a good situation. It's usually not the best. It's usually not the most accretive for owners either. So I think we'll try to avoid, certainly, forcing people out to sell the house. That's not what we're here to do. I think it's more about being really cognizant of when homes leases are expiring. We're working to adjust our term lengths to have them expire to give us the most optionality on when to sell, so that people already kind of know when their lease is up anyway, which is a much better experience for the tenant in terms of us selling the house, right? We're not like selling it and forcing them out. So that's I think a way to solve that without kind of what you were describing.
Wonderful. Awesome. Thank you both for walking through it. I know we're getting quite a few or a couple questions relating to selling if it's a property part of the single family residential fund. And then we have one for vacation rental. Likely as we get closer to sales for each of those asset types, we will have webinars that correspond, but I want to make sure that we're touching on these briefly just to outline. So Kenneth asked, is this the case for vacation rental properties in terms of selling a property? Cameron, I'll kick that to you.
Yeah, so with vacation rental properties, there's not any sort of long-term lease in place. So the complexities involved with coordinating on a 2-year schedule and with a tenant, they're not present for vacation rentals. There is, though, the complexity of the fact that vacation rentals are furnished. So we're anticipating that the more likely situation is that, once we demonstrate that good stabilized income generating performance and kind of package it more like a business and selling a business rather than a home, that those are the channels and the buyer profiles that would resonate more with a vacation rental. Now, certainly there could be somebody who wants to buy it furnished. We tastefully design a lot of the vacation rentals. They have good amenities. So somebody could totally value the furnishings and want it already designed in the way that it is for their own occupancy. So that, we would list them on the MLS because, as I mentioned earlier, both investors and owner occupants alike see listings off the MLS as the primary source of what is available for sale. But yeah, you don't have the long-term rent complexities, but you have additional furnishings that may provide more value to an investor who intends to keep running it as a vacation rental.
Fantastic. Awesome. Great question, Ken. And we'll be sure to, I think it's great feedback from what we're seeing around the questions. I will say too, this webinar is very timely as our first 2 rental properties that we have are up for sale. So that's the Centennial and the Dewberry. I linked those in the chat for folks. Even if you have invested or have not invested, it's great to click through, go to the performance tab. You can view the full property timeline in there. It has a link to the Zillow listing. I know oftentimes we have investors that like to follow those. And then if there's ever any changes to those, we usually have an operational buffer between statuses that you'll notice on either Redfin or Zillow. And then when it's updated on Arrived and then emailed out to the investors in those properties. We started selling shares in our first 6 rental properties in March of 2021. So we do have some that are getting close to that 5 to 7 year hold period. As Cameron talked through and Jeff as well, that is flexible. So we can always sell before or after that timeline. But as I walk through, that's what we have in place today. Want to give some context just because I saw Deborah asking if we've sold any. So it's always good to walk through the kind of the why behind the webinar. All right, a good one here from Stephen. Love seeing you here today. Will we get some idea of the gain when sold rather than having to wait until January to see it on the 1099? They're asking for tax planning, which makes sense. Cameron, I'll kick that to you.
Yeah, definitely. So when we sell and after we get the final HUD in kind of itemizing all the closing costs, then we'll have a much more precise idea of the net funds coming in. Then we'll add that to the balance sheet, kind of close out and net out current assets and current liabilities to get to more of that liquid cash number. And some of the current liabilities might be something like an in-flight expense owed to a vendor, for rehab, or a tax bill that is getting paid, but then, settled, but that was netted against the HUD statement where, you prorate taxes. So there are those current assets and current liabilities netting that's on the balance sheet that also needs to be factored in to that number. So a couple of the, it's kind of hard to exactly predict what the net share price would be. So, to your point, when it's sold, then we'll have that better idea, perform the accounting, and then make the distribution from that point. So you won't have to wait until you get the 1099 back. We'll be able to provide like very accurate accounting pretty soon after it's sold, and then that will be the distribution amount that, well, you'll actually know because it'll hit your arrived wallet pretty soon after the sale. So you'll know how much per share that you got back. And then one other element is that on the portfolio page, you'll also see the kind of lifetime returns with the dividends, and then the gain on the share sale as well.
Fantastic. Yeah, always a good question. I know we have a couple FAQs and resources on taxes as a whole. So if there's any other questions there, definitely let us know. All right, moving back over. A good one in here from Amoma Ventures. Can you explain the amount an investor receives after a sale as it relates to how many shares they own? It's a good question. I think another person on the line also had this as well.
Yep. So the answer to this is fairly simple because we only have one class of shares. So there's not any sort of different tiers of preferred shares, common A, common B. It's very simple. Everybody has a common share, and the only difference is how many shares that you have. So the way that it's calculated is we take the total net funds after all accounting is performed and how much liquid assets are there, divided by the total number of shares outstanding, like not just for you but aggregately, and then that's how much the value is per share. So if you had 10 shares versus 1,000 shares, it's all the per unit economics is all the same. There's not any sort of tiering. So that's how that part of it works. And that's how it also works on the front end when you're investing, that there's not any sort of like discount or different type of, fees based on how many shares that you buy. Everything is proportional to that single share.
Fantastic. Awesome. I saw Jake shared that in the chat as well. So always good to walk through. All right. Moving back over to the queue here. I believe we got that one. All right. Paige, great to see you here today. I understand most of the properties have no mortgage so far. If a property is refinanced with a mortgage later, will investors get partial investment principal back?
Yeah, definitely a great question. And I think what Paige is referring to is our flexible financing and a strategic refi program. So observation's correct that for the last 2 years, we haven't gotten mortgages on our properties. For the first year and a half, we did get mortgages on our properties because it was at a more favorable rate. But in the event that we do take out a mortgage as rates continue to drop, then there's going to be an amount of cash that is distributable to investors. Now, some of it might go back into the asset if there are improvements needed. But we do anticipate that on a refi, the overwhelming majority of funds would go back to investors.
Fantastic. Awesome. Definitely a great question. For folks that are newer here, and like you mentioned, Cameron, none of our properties currently carry a mortgage. You'll see that strategic refinance candidate tag located on each individual property page. We also have that on the single family residential fund page as well. Like anything that changes with properties, folks would be notified if that was the case as well. All right, moving back over to the queue here. Ooh, a good one from Steven. Have you considered giving redeemed investors first rights on similar properties in the same area so they can replace their investment? It's a good question.
Yeah, that is a good question. Candidly, I don't think we have contemplated that kind of feature. But we can definitely go to the drawing board to see if that's something that we can build into the platform. There may not always be the option though as well. A lot of markets that we purchase in, we could be both simultaneously purchasing and selling. So I think that you could have that sort of option in there. Other markets, it may be that we haven't since acquired, and we don't think it makes sense to continue to acquire. So that option wouldn't be available. But it's an interesting idea that we can bring back to our product team.
Yeah, I think just jumping in here, one thing that we could do on acquisition side, I mean, we would certainly be cognizant of what we're selling and where we're selling and kind of what our investors' portfolios look like. And if we are selling, a few in a market and we're not selling it because it's in that market, we're selling them for house specific reasons. I think it's very reasonable for us to be buying more there to kind of replace that or to kind of refill that opportunity in that area. So that is a very interesting idea, though.
Absolutely. I was pinging our product team and folks on the side. So, Stephen, great idea here. I could even see, even if it's not a similar market, folks having access there, depending on the properties that we have. But great feedback. We are building for and by each and every investor. So keep it coming our way, whether it's a market you'd like to see, a new asset class, updates within the platform, so on and so forth. We'd love to hear from all of you. I think we've cruised through the queue here. Please keep me honest in the chat if I've missed any. Want to make sure all of your questions are answered and voices are heard. I believe we caught this one earlier, just around, they mean the profit and sell that distributed per share and how. Cameron, I believe you walked through this in short, depending on the shares, what would folks receive? Maybe we just double down on that before we close our virtual doors.
Yeah, sure thing. So the profit, the full cash flow will come back to you, including, likely your initial investment. So if we sell the property and the end accounting results in $12 per share instead of the $10 per share that you bought it, then that $2 per share is going to be the profit that will have tax implications on it. But when we're selling the property, just want to be clear that it's not just a distribution of the profit. It's also it's the full distribution of the entire basis as well. So, you buy a property for when it's $300K, we sell a property when it's $400K, that extra $100K is not the only payout that you get. It'd be the full $400K. So hopefully that clarifies what is distributed back out when we close out an entity and then make the distribution, but it's the full cash amount.
Absolutely. Wonderful. Just a good one to walk through. I feel like twice, especially as we have properties that are coming up for sale and what folks can expect for existing and then new investors as well. It looks like I had one DM sent. It's a good one. I don't think I can put these up for Q&A. Let's see here. Oh, it'll work. Do we expect the U.S. homeowner insurance difficulties to shrink our potential pool of buyers? How do we take that into consideration? It's a great question. Jeff, you went off mute, so I'm going to kick to you.
Yeah, and that's one of the reasons I think we're less enthusiastic about buying in Texas and Florida specifically right now. I mean, there's even parts of coastal Carolina that have become harder to underwrite, and not just harder to underwrite today, right? So, when we're sitting here trying to figure out the cash flow and the returns on an asset, and it's not just that we know that the insurance rates are higher now, it's that we lose visibility into the future. Obviously insurance rates probably can't just go up forever. At some point there has to be some limit. But it does put a big overhang of unknown and risk on the homes. And potentially at some point in the future that could even turn into a reason to buy there if prices get affected. But for right now, basically prices have kept going up or stayed about the same, and insurance has gone up a ton, which makes cash flow difficult. And then combine that with the unknown of the ability to get insurance, and how much demand is going to be impacted by everyone else's inability to get insurance. A lot of people in Florida right now, I believe, anecdotally, are just going without homeowners insurance because they can't afford it anymore. So they just don't have it anymore. That's not really an option for us. And I don't think that's really a good option for most people. So if that's kind of the trend, I do think it puts into question some of the value long-term of that real estate. So we are considering are exits there, certainly, in addition to just the challenge to cash flow that it would be today.
Yeah, and I think that it doesn't necessarily shrink the pool of buyers per se. What it does is reduces their purchasing power. So when you get underwritten for a mortgage, your principal, interest, tax, they're all factored into how much the bank will lend you. And the higher that the numerator is in terms of your obligations, including insurance, then the less loan value that you're going to get, and therefore the less purchase price you're going to be able to offer. So it's not to say that we would never purchase properties in markets with high insurance costs, even without kind of that future visibility that Jeff was referring to, which I think is a great point. And one of the risks is that it could keep going up. What's 2% today could become 4% 2 years from now, and that would, really hurt the investment. But it comes down to the economics of how much buffer do you have. So if you found a really screaming deal in a market that you do have conviction in, even with high insurance costs, it could still be a buy, because knowing that, like, even if your gain is compressed into the future, you're kind of what your profit is locked in on the buy, right? That is kind of one of the old sayings in real estate, really just to emphasize how well are you purchasing and what kind of good opportunities can you find. So I would just look towards some of those markets like Florida and California too, with the wildfire risks and a lot of insurance carriers pulling out, and then you have lower supply of insurance, and then you have higher premiums because of that. That does impact our view of future appreciation. And I'm sure that also rolls through in a lot of the data that we consume for market valuations, that is getting incorporated. So I think we've done actually a pretty good job of navigating this landscape and kind of avoiding some of those like areas that did run up quite a bit. Not to say we're fully immune to it, but in general, I think we've managed insurance pretty well and have a great carrier as well. So most of that issue is mitigated on avoiding purchasing, rather, because there's really not too much you can do with insurance prices without taking a material amount of risk. Like Jeff was saying, you could just straight up not have insurance, but that's not a good way to invest, let's say.
Absolutely. Yeah, definitely a great question. Dee said, great explanation, and they're grateful. I will say too, we released the beatbox at 10 a.m. PT. It looks like it's already fully funded. So if there's any folks on the line here that invested, thanks so much for investing with us. For folks that might be interested in vacation rentals in the future, you can go to any coming soon property and sign up for text or email alerts, and we'll notify you for any single family residential properties or vacation rentals. Yes, vacation rentals. I got sidetracked by Jake mentioning T-minus 5 minutes to rate cut announcement, assuming that it's right on time. So it might be very timely for where we are right now. I did see a question in here that's always good to answer more in general about what growth looks like for Arrived in different markets. Is there a plan to enter growing markets out west more? Most of the single family I see, CBO, sorry, Chief Barking Officers are out and about. Jeff, I'm going to kick this one to you.
Yeah. So, we are always constantly underwriting the whole country. We're always looking everywhere, depending on deal flow, availability, things like that. Certain markets tend to get overrepresented for short periods of time or underrepresented. I think a lot of the markets we like out west, or some of the markets that are, better out west. So, the Phoenix area, I think, is growing and will continue to grow. But prices there got pretty out of whack a little bit. And so it made underwriting very difficult. And it made it less attractive relative. Albuquerque, we thought was and is still a good opportunity. Not quite as expensive, and kind of a more, certain parts of Albuquerque at least are more unique, and I think you will see more of those. But yeah, a lot of the Western markets just kind of found themselves not in the right spot in the cycle. But we are certainly always underwriting there, and look to do that. Look to both for, we know our investors want diversification. We know you guys want a lot of different places to buy, and that's good for your portfolios in the long run. So I know it does seem a little Southeast heavy recently, but I think you can expect to see more in the West as kind of the landscape unfolds over the next year or so.
Yeah, and this is really illustrative of, or at least will give some insight into where have we prioritized areas to buy in that we think will deliver the best returns? So what colors this is kind of two things. One is the rise in interest rates. So there's a big difference between, 3.5% mortgage and a 7.5%, and that change happened within 9 months or so in the latter part of 2022. So we shifted our strategy to prioritize affordability, because when you do have those really high interest rates, the affordability just plunges. And if your land cost is already expensive, like it is in coastal areas and in the West Coast in particular, then your purchasing power is affected quite a bit. So we thought that growth would be impaired there, given the interest rate environment. And then the second has to do with prioritizing newer assets. We wanted to minimize the amount of rehab and renovation costs and ongoing maintenance. We liked the security of having a builder's warranty for major structural things. So we also kind of proxied a lot of the good investment volume by seeing where are large builders, where are they setting up communities. I mean, they are very well capitalized, large, sophisticated companies that do a lot of research on demographics, anticipation of the future of where people are moving to, infrastructure that they build their communities near. So, it's kind of like what Home Depot and Lowe's do with each other. Lowe's kind of follows wherever Home Depot goes because they know that they're doing the research. So to the extent that it fits with our cash flow optimization of going towards new assets, the fact that resale volume really dried up, so the spread in price between a new asset and a resale asset was very minimal. We prioritize affordability and those new assets, all kind of being caused by this interest rate hike. So more opportunity, we believe, in the current kind of cycle of real estate exists in the Southeast. And then as interest rates get to like critical levels, I'm going to throw out a number there, don't hold me to it, but let's say interest rates are sub 5.5% again. I think that really starts unlocking some of those Western markets that we were previously purchasing in, like Denver, all along the I-25 corridor in Colorado, purchasing properties in both Phoenix and Tucson. We were looking in Las Vegas for a long time, as we think that's also a beneficiary from like repositioning California. So a lot of people who have lived in California for a long time that have a lot of large gains and are exiting the state, a lot of those other Western markets are the beneficiary. So we like that play. Interest rates kind of put a damper on it, but it's all, affected by interest rates. So as they come down, that'll expand the number of markets that we feel are risk mitigated.
Definitely. Looks like 11 o'clock. So we're waiting for the Fed cut or the Fed rate. There we go. Maybe we actually, let's just take this one live now. I know Stephen has one in the queue. Cameron, Jeff, what are your thoughts on that rate cut?
I defer to Jeff first. I mean, he's definitely well versed in markets. So
yeah, I kind of thought they would do 25, given kind of the slightly better economic news earlier this week. I mean, I think 50 is right. I think the Fed's probably a bit behind. Typically, the 2-year bond yield kind of dictates where the market thinks the Fed should be, roughly, and it's 3.5 or so. So the market thinks the Fed should be much lower, and good. I think the market so far, at least, although that you have to give it a few days at least, but the market so far seems to like the fact that the Fed is going quickly. So yeah, we'll see, but basically the Fed did what the market wanted it to do, or what the market is expecting it needs to do. So it likes it.
Yeah, so I think that it's probably the right move, given how fast the interest rates went up. It certainly did its job of slowing the economy down. One risk that I see of a 50 versus a 25 is kind of the whipsaw nature of how the Fed would, curb these problems. So in a period of 9 months, we went from a near zero 10-year to near 5%, and then we went from 3.5% mortgages up to 7.5%. That was really fast. So it probably tells you that they waited too long to raise rates, and then now they're coming down with a 50 basis cut, saying like maybe we went too fast, and then now we're having to come back down because we're maybe risking a hard landing if we don't cut enough. So even though thinking it's the right move, it does introduce a higher amount of volatility into price swings of different assets. And I'm not just talking about real estate. I actually think real estate will remain fairly stable. The intuition is that your purchasing power should go up quite a bit as rates come down. And I think that mathematically that's true. But interest rates are an input into supply and demand. And ultimately, supply and demand is what governs price. So I think what we'll see, whether it was 25 or 50 basis points, is that you'll have more transaction volume starting to brew in the market. More sellers will be willing to sell their property because they see a cheaper mortgage that when they're substituting into, they're like, okay, I need to move, and I can tolerate this price difference in my payment. And that will be an offsetting effect to the increased purchasing power that buyers are having by rates coming down. I think one other impact of the Fed rate cuts on interest rates for mortgages is that the spread over the 10-year, and this is kind of some like kind of technical mechanical stuff with mortgage rates, but the conventional mortgage rates are typically a combination of a 10-year plus a spread on top of it. So you would take the 10-year rate and then add a risk premium on top of it. And for the last year and a half or so, that risk premium has been really high, like generationally high at close to 3%, which normally is not that much of a spread over it. So as rates are expected to come down, I think the spread will start coming down as well. So it's not just that the 10-year is coming down, it's that the spread should start compressing, which will kind of like accelerate the rate at which mortgage rates come down. So I think that will be a nice, powder keg for buyers to start buying more, but offset by increased supply because we've been supply starved. And just like one last thing on the interest rate lock effect, you would have expected that prices cratered when you went from a 4% mortgage to a 7.5%, but it didn't happen because of the interest rate lock effect, which took supply off the market. So it's kind of why I was also leading with the idea that interest rates in of themselves don't govern the price of real estate, or it's got a secondary effect which heavily influences supply and demand, but the intuition of prices going down didn't happen because supply correspondingly dried up because of this like substitution effect. People didn't want to substitute out of their current mortgage. So all that to say, kind of staying the course on price expectation, I think we'll see appreciation on the national front. That's kind of in lockstep with whatever inflation's at. Certain markets will continue to go up, other markets may go down, but overall, I think we'll see a lot more transaction volume.
Fantastic. One moment here. Just moving into the queue. Very timely. Jeff and Cameron, how are you both doing on time? I know we're over. We have 3 more questions in the queue.
I'm here for the main event.
Awesome. Very timely. It's a great day. Beatbox being released. We have properties for sale, Fed rate cuts, so on and so forth. A quick one that's not directly related, but always good to answer. Why was the beatboxing coming soon for so long?
Yep. So the short answer to this is that it was with the SEC for a while in various stages. There was not an issue with the offering. It kind of gets down to the mechanicals of qualifying your offering entities. Every so often, the SEC will go through like a more extensive review of your offering. So there were some just comment periods back and forth. And as we've been evolving as a platform, we're introducing new programs into our offerings. So that can always introduce some potential delays in like getting qualified. And when I say getting qualified, it's basically the SEC saying this investment can be sold to both accredited and non-accredited investors. And we had also slowed down the purchasing of our vacation rentals in general. So by the time that this was like the back and forth was resolved, it had been too long of a period of time before we had offered another investment. So we kind of had to get requalified again on the entire offering. So that was an outlier reason for why Beatbox was like ready to go as in coming soon, but it took a long time for it to get qualified, just as kind of a series of events and kind of growing pains on just managing the securities life cycle. But it didn't have any impact on, say, like performance or the offering components. It was really just more of a regulatory process issue that we're going through with this particular issuer, which is called, STR2 short-term rentals, Arrive short-term rentals 2. But all of those have been cleared up now. So we could expect a more regular cadence of qualification for those vacation rentals in that offering.
Absolutely. Conrad made a comment in the chat for the beatbox. It's nice to hit the ground running with reviews. I can't take the credit here. It's all credit to our vacation rental team. I think Carly is on the line here, Rupanthi, Jules as well. So huge kudos to the team on all the work done there. As folks know, vacation rentals are much more involved, I would say, than our single family residential properties. It's literally the difference between passive and active when you think how many folks are in and out of those properties and all the operational efficiencies there that the team has created. So huge kudos to the team on that front. All right, moving back over here, a good one from Steven. At what mortgage rate level will Arrive start to refinance existing single-family residential properties? Good question. Cam, I'll kick to you, and Jeff, if you have any context too.
So gut feeling is that it's somewhere in the low sixes for a certain set of properties that demonstrate the ability to like bear the mortgage. And not all so I don't look at it at one level. We either turn mortgages on or off. It's more so that we get to have kind of a hindsight bias in saying which properties have been performing really well. They've got their kind of Cinderella long-term tenant who wants to stay there for a really long time, so we're not having vacancy and turn expenses. The market could be accelerating on appreciation, and that would be a nice bullish signal to get that effect of leverage. And other properties, they may still be ramping up, and it's not demonstrated yet that they can bear the cost of that interest rate. So we would make the choice to not put mortgages on those properties. So it all comes down to the underwriting. I would say that there's a lot more possibility at higher rates for properties that have already been stabilized and are operating well. That threshold of interest rates needs to be lower before we put it on properties at acquisition going forward, because there's still an unknown element, right? I think for certain properties that are killer deals and we get a really low basis, you could probably afford to do that. But a lot of interest rate management also has to do with the kind of the yield you expect on the income. So it's not to say that the yield always has to be higher than the interest rate before we do it, because there's also the component of appreciation. So interest rates lever both the income yield and the appreciation. So if you can find the right blend of really good market appreciation and like the expectation that the market will really appreciate in price, you could still have a cap rate, as we call it, capitalization rate, but that's basically the income yield. That could be lower than the interest rate, and it still makes sense to put that mortgage on the property. But the overall guidance is that it like we, as interest rates walk down, we can incrementally put them on properties that are predisposed to being higher yielding and appreciating more. And then once it reaches an even lower rate on like what kind of the going conventional mortgage rates are, then we can start placing that on properties we're acquiring. And I would guess that has to be more in the 5 to 6 range instead of the 6 to 7 range.
Absolutely. Yeah. Great question, Stephen. We'll have more content circulated around that once we get closer to it. And obviously, we'd let folks know too, as well, I imagine in the performance tab. But looks like we have another good one in here. Momoma Ventures asks, with the rate cut, will Arrive cut the private credit fund below 8.1%?
Yeah, so there's not the plan to, and it all is a function of what kind of underlying loans can you acquire. I've been in the kind of private lending market for over 10 years now, and as rates, stayed low for the 2010s and then went up, I haven't felt much of a underlying interest rate change for those, fix and flip loans and bridge loans for residential real estate. It's all stayed fairly stable in a low double digit, high single digit area. I think different parts of the country have different going rates, but in general, there's a bit of separation between government yields and risk-free rates versus the private lending market for real estate. So we don't anticipate that we'll have to, but it's all going to be dependent on the market. It'll be dependent on our ability to keep finding great loans that have good risk-adjusted returns. But so far, even with all of the lead up in anticipation and kind of the prediction markets pricing in these cuts, we haven't seen rates change yet from any of the originators that we're purchasing loans from. So we'll maintain it as long as we can, as long as the underlying loans keep performing and we're able to source them effectively. But just in general, there is more of a separation between those two markets of risk-free rates and residential short-term loans.
Absolutely. Yeah, definitely a great question. Let me just recheck the queue here. I think we cruised through all of them, which is absolutely fantastic. We got one more from Steven. Steven's always got the great questions in here. Let's see. Before we shut our virtual doors, we'll take one last one here. If demand for private credit fund increases a lot due to the lower rates, can you keep finding sufficient supply? Very timely question.
Yeah, I feel pretty good about the supply because, let's go back to one of the other positions we hold, which is transaction volume will increase. So as transaction volume increases, you have more opportunity for real estate developers to acquire the properties, rehab them, build them from ground up. More people will need bridge financing because they're selling their old homes and going into new homes. So the overall supply of the loans should increase. And I think that your observation is also correct, Stephen, that if we're able to maintain that yield or near that yield and rates are coming down significantly, then the gap and the accretive value that the private credit funds keeps increasing over risk-free rates and money market accounts. So I think that much like any market, supply will respond in response to demand. But overall, with real estate activity projected to increase, then we would be able to keep finding the adequate supply of those loans.
Fantastic. Awesome. Definitely great questions today. As I mentioned, what a historic day, not only for Arrive, that we have properties that are coming up for sale since the inception of when we started selling shares in March and April 2021, the Beatbox being fully funded, the Fed cutting the rates, so on and so forth. So lots of movement today. We so appreciate folks jumping on for an hour 16. Cameron and Jeff, any closing remarks before we shut our virtual webinar doors?
Great audience, great questions. Always appreciate the chance to do these webinars, and especially for kind of special topics like this that go beyond our usual 101 webinar. So just want to thank everybody for their time and appreciate all the questions.
Yeah, I love doing these. I love seeing how engaged our investors are, and how they're always asking the best questions, the right questions, and they're always proposing new ways for us to look at what we're doing and how we're doing it. Yeah, love doing these. Always great to hop on and interact with our investors.
Absolutely. Well, Cameron and Jeff, thank you so much for prepared remarks. Phenomenal job, obviously, with the diversity of questions that came in the queue today. So thank you. Massive kudos also to our team who you see in the chat. Love having you all in here today and with the clapping along. I will also say to our investors, thank you. We're always building for and by you. We so appreciate you spending, an hour 17 filled with engagement and fantastic questions. As Cameron mentioned, we host our weekly webinars, our intro to Arrived. Feel free to join those. I know we have a lot of existing investors that come 20 to 25 minutes after prepared remarks. Also, if there's a webinar topic that you would like to see done in a webinar, let us know. Feel free to ping support@arrive.com. You can also use our chat function in the bottom right-hand corner of your platform. But I hope you have a great rest of your day and happy investing.